All right, let's get started. Well, in the last chapter, we learned about the differences between absorption costing and variable costing and how they can affect the operating income. Let's consider some situations where managers make decisions. Well, as I said, managerial accounting provides the internal information users to assist them to make business-related decisions. So, in this class, since we have known the difference between variable costing and absorption costing, let's take a look how variable costing can help the managers make business-related decisions. Well, in some cases, variable costing is more appropriate for decision making, but in some other cases, absorption costing is more appropriate. So here, let's see some cases where variable costing is more appropriate. First, setting sales price. Well, in the long run, the sales prices charged to customers must cover the full cost of the product. The full cost includes every part of the life cycle of the product, including research, development, design, production, distribution, customer service, and disposal. Any fixed manufacturing cost must be included. So absorption costing in this case is more appropriate when determining the product cost for the long-term planning. But in the short run, variable costing should be used in some cases. For example, if a company has exceeded capacity and has a one-time opportunity to accept a customer order at a discounted sales price, the order should be accepted if sales price exceeds only the variable cost. Well, in this situation, fixed costs are not relevant because they would be incurred whether or not the order is accepted. If the fixed costs are not relevant, they should not be considered when making such decision. So in this case, variable costing, I mean in the short run, in this case, variable costing is more appropriate. So short-term pricing decisions are covered in more detail in later chapter. And the second decision, let's see, the controlling the costs. We sometimes think that some costs are not controllable. For example, if the company signs a 5-year lease for the manufacturing facility, the rent expense is fixed and that will remain fixed for the next 5 years. But in the long run, all costs are controllable. Well, let's see. After 5 years, the company can renegotiate the lease, rent another building, or buy a building. Even though the cost of occupying the manufacturing facility is controllable. It is a decision made by upper management. The production supervisor does not control this cost. So most fixed manufacturing costs are controlled by upper management. So managers should focus on and be accountable for the costs that they can control. At the production supervisor's level, the controllable costs are the variable manufacturing costs, including direct material, direct labor, and variable manufacturing overheads. Well, this is concerning the costs. Next, planning production. Production planning decisions are similar to sales price decisions. Short-term decisions should be made using variable costing, and long-term decisions should be made using absorption costing. In the short run, production is limited by capacity. So, production supervisors should produce the products with the highest contribution margin per unit, as long as there is demand for the products. Producing and selling the products with the highest contribution margin per unit generates the highest operating income. So, in the short term, variable costing is more appropriate. But in the long run, capacity can be expanded because expansion would affect both fixed and variable costing. Absorption costing is more appropriate. Production planning decisions are covered in more detail in later chapters. And next is analyzing profitability, which is the most important part in this chapter. In this chapter, the most important part for managers to use the variable costing to do profitability analysis. So from now on, I will use two fictitious companies to illustrate how variable costing can be used to do profitability analysis for both manufacturing and service company. Well, we look at the profitability analysis in the last chapter, CVP analysis, when we calculated the sales needed to break even and earn a target profit. Let's now in this chapter to expand that analysis to include decisions about products and business segment. Well, in this type of analysis, it is more helpful to use variable costing. And here we will continue using the Smart Touch Learning company, which sell two types of tablet computers. Well, in terms of products, let's see the basic information. As I said, Smart Touch Learning is selling two types of tablet computers. First, the first type is standard type, and the second type is the premium model. Where the premium model has several superior features, including larger screen, a faster processor, longer lasting battery, and more specialized software program. And of course, the premium model costs more to manufacture and has a higher sales price. The premium model is new for the company, and the sales representatives have been encouraged to promote the new model. So, in addition to the sales price information in these slides, in addition to sales price and variable costing, we can also see the sales commissions per unit. Well, for the standard model, the sales commission is 5% of sales price. And as I said, the premium model is a more advanced and the newer product. So the sales commissions of premium model has a larger percentage of the sales price, that is 10% of sales price. Well, for standard type, the sales price is $500, so the sales commission is 5% of $500, which is $25. For the premium model, 10% of $600 should be $60. $60 as the commissions for the sales representatives. Well, this is the basic information of two types of tablets computers that a Smart Touch Learning company is selling. Next, let's see the business segment information. Well, a business segment is an identifiable part of the company for which financial information is available. Business segments can be usually segmented by geography, customer types, product types, or salespersons. Well, here in this case, we have two business segments divided by, segmented by salespersons, or simply speaking, in other words, in this case, in Smart Touch Learning Company case, in addition to two types of product models, we still have two salespersons, or say two business segments. So we assume that the company has two salespersons they are Salinas and Carrie. During the last accounting period, both sales representatives sold 1,250 units. Well, these same amount of units, 1,250. And this slide shows the contribution margin income statements for both sales representatives. And it determines the contribution margin ratio. But please note here, each 1,250 units is a mix of both types. This, let me change the color. Well, both representatives made a sales of same amounts of units, 1,250, but it is a mix of both models, either premium or standard. Well, in this table, we can see although they sold the same amount of units, although they made sales of same amount of units, they had different sales revenues, and different variable cost, manufacturing cost, and different sales commissions. So these differences result in different contribution margins, as well as different contribution margin ratios. Well, as a reminder, again, here, contribution margin means sales revenue minus variable cost, and the contribution margin ratio equals contribution margin divided by net sales revenue. Okay, next. Let's see this slide. Well, this slide shows that even though both sales representatives sold the same amount of tablets, Selena had higher revenues, whereas Carrie had a higher contribution margin and contribution margin ratio. Let's look at each sales representative in more detail by examining how the sales mix affected this result. Well, the more detailed statement is shown in this slide. It shows how the sales mix of each representative affected the total contribution margin. Selena's sales mix was 68% of the standard units and 32% of the premium units, while Carrie's sales mix was 92% of the standard units and only 8% of the premium units, because the standard model has a higher contribution margin than the premium model. As we can see, for the standard model, the contribution margin ratio is 46% versus the contribution margin of the premium model is only 30%. Well, so because of the difference in contribution margin ratio, this different sales mix has an effect. So the more you sell of the standard model, the higher contribution margin. The combined contribution margin ratio that you will have. That is the Carrie's case. Well, please note here, you should pay attention to here, this amount. The total contribution margin ratio. This number is not simply the sum of these two. The total of contribution margin ratio is not the sum of the contribution margin ratio of each types of different products. Instead, it is a calculation. It is calculation using this information. Then we get the mixed contribution margin ratio. So now we can explain why Carrie has a higher combined contribution margin ratio. At least, higher than Selena, because standard type has a higher contribution margin ratio than the premium model. And Carrie sells more units of standard model, more than the premium model. Well, that's the case. Even though the premium model has a higher sales price, but premium model, as I said, also has a higher cost. That is important. Well, actually, in today's world, most companies do the same thing. They have high-end and low-end production lines, different production brands. For example, the car company, they have high-end branded cars and low-end branded cars. Well, we would think that the contribution margin ratio for high-end vehicles is higher, but because the high-end vehicles has a much higher selling price, But that's not the case, because the high-end branded vehicles also have a high cost, resulting in actually a lower contribution margin ratio than the low-end vehicles. So here, after the analysis, the management should make the following questions. They have to consider first, should the sales representative continue to focus on the premium model if it has a lower contribution ratio? And the second question to consider is, should the premium model have a higher sales commission than the standard model? Thirdly, they need to consider what steps can the company take to improve the contribution margin ratio on the premium model, to increase the sales price, or to decrease the sales commission, or to decrease the variable cost of goods sold. Okay, in this discussion on profitability analysis, we analyzed the effects of sales mix on profitability. But now, let's look at the effects of changes in sales volume, changes in sales price per unit, and variable cost per unit using a new scenario of this company. This is another situation in which it is helpful to use variable costing. To do this, we will use these slides showing the income statements in contribution margin format for 2 accounting periods for the company. Okay, period 1. The units sold is 500 units. For period 2, the units sold was 400 units. So we can see a decrease in contribution margin. A decrease in contribution margin. We can see the difference is $24,600. At first glance, it appears that the decrease in contribution margin was because of the decrease in the number of units sold. But that doesn't explain the decrease in contribution margin ratio, because theoretically, when the units sold decreases from one period to another period, the contribution margin decreases. That's normal. But if it is just the sales units decrease from one period to another period, the contribution margin ratio should stay the same. But in this case, the contribution margin ratio also decreases. So we will do more analysis to see why the contribution margin ratio also decreases. So to do this, let's take the total amounts and expand them into two components by dividing the totals by the number of units. So this slide shows the expanded statement. Let's take a look in more details. Well, we can now see the changes in contribution margin was a result of changes in both components. The first component was the changes in units, or the decrease in the units sold. That was obvious. But another component that results in this change is actually the amount per unit. Well, let's see. The obvious thing is the decrease in units from 500 to 400. Well, this decrease in units resulted in the increase in variable costs. We can see here, there is an increase of $30. So why is that? Well, actually, this is because of a volume effect and a price cost effect. So further investigation revealed that the direct material cost increased by $60 per tablet, causing the variable cost to increase from 270 to 270 to 330 per tablet. Because of the increase in direct material, the manager decided to increase the sales price from $500 to $550. The increase in sales price from $500 to $550. But because of this increase in sales price, it caused a decrease in the sales unit, the number of units sold. The number of units sold decreased from 500 to 400 because of the increase in the selling price. Regarding the sales commissions, it remains at the same amount, at the same ratio, 8%. Well, because of these changes, I mean the changes in variable cost, in sales price, and the sales volume, the contribution margin ratio also changes. But in this case, the contribution margin ratio decreases from 38% to 32%. Well, here it summarizes the situations in which managers must make decisions and then costing system that is more appropriate for each situation. This slide and next slide. Well, the previous discussion was how variable costing is used to make management decisions for manufacturing business. So let's see how it is used to help managers to make business decisions in a service company. In a service company. Well, when service company is mentioned, we know that the service company provides services other than the products. So, service companies do not have inventories or cost of goods sold. Instead, they have the labors as the cost. But similarly, they do have the fixed and variable cost associated with providing services. Because service companies also have both fixed and variable costing. This costing methods can be used to analyze the profitability also in the service company. So to illustrate these points, let's consider a fictitious company called JR's Towing, a towing service company, which owns a small fleet of tow trucks used to pick up cars involved in the accidents or mechanical breakdowns. And they tow the car to deliver to the repair shops. Well, this slide lists some accounts in JR's towing company. They have towing revenue, trunk expense, which is a variable cost, as well as driver expense, which is a variable cost, depreciation expense, and shop expense. These two expenses are fixed cost. So similarly, we can see for service companies, they also have a source of revenue. They provide towing services. They also have the variable cost. And they also have the fixed cost. Well, this is the income statement in contribution margin format. Shown the revenues in 2018. Revenue minus variable cost, we get the contribution margin, less fixed cost, we get the operating income. And by separating the cost by behaviors, the company can calculate the contribution margin by dividing the contribution margin. They can calculate the contribution margin ratio by dividing the contribution margin by towing revenue. It is 51.11%. And at the level of sales provided in this accounting year, the company is operating good above the break-even point and is able to first cover the fixed costs and also generates profits. This service company has analyzed its data and determined it can separate the data into two business segments: city and country. Towing services provided within the cities are shorter routes and take less time, whereas the towing services provided outside the city are longer roads and takes more time. Also, due to busier streets and more accidents, the company tows more cars within the city. So here it is a revised income statement showing in more details, segmented by business segments in both city and country and countryside. But here it is where you should pay attention. The fixed cost listed only in total column. Here we can see the fixed cost listed only in total column. Well, that's because these costs are considered as common cost, not segment cost. The company, that is to say, the company will incur these costs even if there are changes in the two business segments. So they are no relevant to the analysis. But by separating revenues and variable costs by business segment, we can see the city jobs are more profitable, with 60% contribution margin ratio, compared with only a lower 40% contribution margin ratio for county jobs. So the next step is to determine why these two segments have different contribution margin ratio. To explain why these two business segments have different contribution margin ratio, let's take the total amounts and expand them into two components by dividing the totals by the number of jobs provided. Well, from this slide, we can see the change in contribution margin was a result of higher variable costs for the county jobs, which require longer trips and therefore cost more in gas and drivers' wages. The variable cost for city jobs are $30, while the variable costs for county jobs are $45. $45. But the interesting thing is that the company charges customers the same amounts per job, $75. Based on this analysis, the management should consider a different fee schedule for jobs outside the city limits. So you can consider how the managers could reschedule the fee charged to each customer outside the city area. Well, it is your job to take this consideration. Okay, that's all of this class. Well, in this class, I used two fictitious companies to do the profitability analysis. Basically, to do the analysis in more detail, it is a common method to look at the per unit cost and per unit revenue by dividing the total amount by the number of units sold or the number of jobs provided, for service companies. So by looking at the per unit information, we can have the analysis in more greater details. All right, that is all of this class. Please let me know if you have any more questions, or I will see you in the next class, which is after the spring break.